Okay. Which of the following best distinguishes macroeconomics from microeconomics? Okay. Read through the options, then tell me which answer you are going with. Okay. And the good thing will be to justify your answer for your colleagues. Okay, so that they understand why the answer is correct. Yes. So anybody? Question one. Yes. Why do you say that's correct? Yes, yes. Why do we say B? Oh, that's aggregate demand. Aggregate demand spending. Aggregate demand spending. But when you hear the word aggregate, it means the whole thing. A whole thing. That's what on colleagues. I'm not sure first one. Yes, aggregate is the whole thing as a whole. Then aggregate demand, the whole spending by the whole economy, basically. Okay, so here when we say aggregate economic variables, these are factors that affect the whole economy: inflation, unemployment. Okay, these things can affect the whole economy. So yes, colleagues, this is B. Any questions? A would have been correct if it was switched. It was He has been swapped. That's why it's wrong. Okay. Microeconomics also is the study of individual markets. Okay. Then macroeconomics, study of the economy as a whole. Yes. Okay. Question two: which of the following is a primary concern of macroeconomics? Because microeconomics is not the study of the economy as a whole here. This is a wrong, and even this one, macroeconomics is not the study of individual markets. So they've swapped. Okay. Number two, which of the following is a primary concern over macroeconomics? The pricing strategy of, huh? Yes, it's C, correct. Yes. Mhm. Pricing strategy of a single firm, micro. Output decisions of a micro. Consumer surplus, all of this is micro, micro. Okay. Just hold on. I just want to look for the keys, but you can read through this question. Then I'll come and continue. The keys for. Okay. Other concerns of macroeconomics, in case they should bring that, uh, as you said, low inflation or disinflation. Colleagues, what is disinflation? Disinflation is when the inflation rate is dropping. Okay. When the inflation rate drops from 8% to 6%, that is disinflation. Okay. Then deflation starts when the inflation rate is now in the negatives. Okay. You have negative values. That's where deflation starts. Okay, colleagues, disinflation drop in the inflation rate. Okay, if the inflation was 20%, the rate of inflation was 20%, it drops to 10%. That is disinflation. Okay. Disinflation drop in the inflation rate. Economic growth in terms of GDP, low unemployment, okay. um, stable currency, trade surplus, exports are greater than imports. Okay, trade surplus, budget surplus. Okay, budget surplus where the cash inflows exceed or are greater than the cash outflows or the expenses. Okay, because if you're running a budget deficit, that's why now your country starts excessive borrowing. And we know with excessive borrowing, you start attracting who? The IMF. The IMF, yes, I mentioned that one, but thank you very much. That's correct. The growth in GDP is. GDP, colleagues, what's the definition of GDP? Because you're going to also see this one in the quiz. What is the definition of GDP? Yes, and what does that mean? Yes, Madam Lavette. Okay. When you become Minister of Finance. Okay. Madam. But thank you, Madam Lavette. Thank you. Thank you for your contribution. Thank you. Yes, Mr. Boniface. Mr. Boniface, yes. Yes, I can get you. Go ahead. Mm-hmm. So that is very correct. Thank you for that. Yes. Colleagues, the total value of goods and services produced within a nation's borders, meaning we're including foreigners. So the Chinese company producing in Zambia is contributing to Zambia's GDP. At the same time, it is contributing to China's GNP. Okay, colleagues, what's the difference between GDP and the GNP? Okay. GNP, in simple words, is GDP excluding foreigners and including your citizens abroad. Okay. With the GNP, gross national product, this is now for your country. Okay, the total value of the goods and services produced by businesses and the citizens of a nation, those within the nation and those that are outside of the nation, meaning Zambian factory in America, okay, is contributing to Zambia's GNP. Dangote, who is here in Zambia, is contributing to Nigeria's GNP. Okay, but at the same time is contributing to Zambia's GDP. So GDP includes foreigners. Okay, then GNP, we take out the foreigners and then we bring our citizens from abroad and we bring them in. Are we okay with that, colleagues? That is GNP. Okay. Yes. Yes. So these are some of the macroeconomic goals which you might see. Okay. Yes. There are others, but these are the main ones. Okay. Get a photo so that you remember this. Okay. Okay. Question three. A country experiences a sustained increase in its production of goods and services over a 10-year period. This is referred to as correct economic growth. Okay. Yes. Yes. So the economists of the nation always project. They say, okay, Zambia in the next 6 years, its projected GDP should grow by this amount. Okay, then when those years come and you're producing less, it means you're doing bad. If you're producing more, then you're doing good. Okay. Yes. Anybody who works for Central Statistics Office here. Okay. Remember, this course is very practical. So we need input from people who are on the ground who are actually doing this. Okay, colleagues. As I said, me the information I gave you is theoretical. Okay. The theory is just making you understand what is happening out there. From the theory, now you go into the practical. Because once you learn a model, then now you see, okay, how does it apply in the real world? Okay. During a recession, which of the following is most likely to occur? So, colleagues, what is the definition of a recession? Yes. Yes. Yeah. Yes. A recession, when we, for example, Zambia, because the GDP is also measured in quarters, then you find quarter one, GDP is dropping. Quarter two, GDP is dropping. Quarter three, GDP is dropping. Then you can say, okay, no, we're experiencing a recession. Falling GDP, high inflation, low spending, high unemployment. Okay. Yes. Now here I've already put the answer. Okay. I wish I never put the answer. Okay. I wish I wanted to hear your answers. Okay. So Here we chose falling real GDP and rising unemployment. Colleagues, what is real GDP? Yes, and that's what it is. You've actually answered your question, sir. You've actually answered your question. Is that okay, Mr. Casono? Or should I go a bit deeper? Okay. Hmm. So every quarter, colleagues, let's be checking and find out how's Zambia's GDP doing. Is it dropping? Is it increasing? Okay, all of this information is on the net. Okay. Okay. Yes. So I was asking, what is real GDP? Yes. Yes. Mm-mm-mm. You're, mi- you're mixing up the words, sir. It's real GDP, which was not real inflation. Real GDP, sir. Real GDP, sir. No, real GDP. There's no. There, yes, you'll never find real inflation. Yes, but continue. That's GDP. You have gone halfway. Thank you for that. But just add the last. Yes, real GDP is a GDP which is adjusted for inflation. Colleagues, why are we adjusting for inflation? Mr. Twambo wants to know why are we adjusting. I saw him in the class. He's been kicked out. Okay, Madam Juanita, why are we adjusting for inflation? Madam Mary, why are we adjusting for inflation? Aha, continue. You're in the correct path. Yes, yes, yes. Yes, the price of goods services increase over time. Uh-huh. Just yeah, on the correct path. Okay, let me finish that for you. So yes, oh, mhm. Yes, the since prices increase over time, and you might find your output has dropped. Stop making noise. Yes, let's say country one in year one. Okay, the price of the good is 10 kwacha, and it's producing 100 units. Its GDP 10 times 100. That gives us 1,000 kwacha. So its GDP is 1,000 kwacha. Okay. In year two, uh-huh. Okay, I'm recording. Okay. Now look at year two for this country. The price of the good increases to 30 kwacha and output drops from 100 kwacha to 50 kwacha. But the GDP is telling us 1,500. So this price increment can give us misleading results. Okay, your GDP looks good. These are nominal GDPs, by the way. This is a nominal. These are nominal GDPs. GDP is not adjusted for inflation. Okay, so you can see year two, the GDP looks like we've done better, but in reality, we're actually doing bad because our output has dropped. Okay, the output has dropped. Okay, the price of the good has increased, but the output has dropped. So it might be misleading. So the way we adjust for inflation is we say, okay, you pick a base year, a year of reference. Okay, so you say, okay, year one is our base year and it is our year of reference. Okay, meaning we are going to use year one's prices to calculate the GDPs for all the years that come after it. Okay, so for year two, if you want the real GDP, you're going to use year one's price of 10 kwach. You said the price has stayed the same. Yeah. Okay. You ignore that it grows to 30 kwacha. The price has stayed the same, 10. You produced 50 units. So your real GDP is 500 kwach. Okay. This is the real GDP. And we can see we have done bad. Okay. Because the base year, the real GDP for the base, because the base year is real and nominal GDP are the same. So the base year, since GDP is 1,000, and the real GDP for year two is 500. So it shows us that in actuality we never did good, we did bad. And that's the adjustment that is made for inflation for real GDP. It uses the current prices, GDP with current prices. Then real GDP with the base year prices. Is that okay? Yes. Real GDP, base year's prices, nominal GDP, the current year's prices. Okay, so yes, here falling real GDP and rising unemployment. Those are a signal of a recession. Okay. Now we come to the circular flow diagram. Okay. In the simple circular flow diagram, which two groups are the primary decision makers? Correct. Correct. Colleagues, are we all okay with that? Yes, because these are found in all sectors. The two sector model, three sector model, four sector model, five sector model. Colleagues, you need to remember this. Do I have, yeah, where was that? Yes, here's the circular flow diagram. Okay, the circular flow diagram. Okay, households provide businesses with land, labor, okay, and entrepreneurship. They also say with capital, okay. They also say with capital, okay. The households provide these resources to the businesses. the factors of production. Basically, the households provide the factors of production to the businesses. In turn, the businesses repay the households with for the land you're paid rent. Ah, yeah, land rent. For the labor, you're paid wages. For the capital, you are paid interest. For the entrepreneurship, you're given profits. Okay? So these businesses use these factors of production and sell them to the households. Okay? They use the factors of production to produce goods and services and sell them to the households. That's the two sector circular flow diagram there. Okay, just households and businesses. Okay, yes. Then three sector, you're going to add government into the mix. Household, government, and businesses. Okay. Households pay government taxes. Okay. Government uses these taxes for government spending. Government spending includes purchasing of goods. Government does purchase goods and services from businesses. So the businesses will make money from that. Another form of government spending is when they build roads, airports, hospitals, schools, building new infrastructure. Okay, another part of government spending is when they are recruiting nurses, teachers, doctors, immigration, soldiers. Mhm. Okay, yes. So it goes to the government sector, then government spends. Then fourth sector economy, household, business, government, and the foreigners. Okay, we buy goods from the foreigners, imports. Okay, and we also sell goods to the foreigners through exports. Okay, the five sector, you add in the financial sector. This is where the financial intermediaries come in, banks, what else? Pension funds, insurance companies. Okay, banks, the commercial banks, the development banks, microfinance institutions. Yes. So, for example, if we use banks as an example, you as a citizen, you save your money in the bank. The bank takes your money and borrows it to a business who will invest and make money, and then they'll pay back the money they borrowed with the interest, and then the bank will give you also a portion of that interest. That's the five sector model. Then you need to remember the leakages and injections. Okay, just remember this acronym. Okay, for the withdrawals, STI, savings, taxes, and imports. Okay, the leakages, withdrawals or leakages. Let me put leakages here. Okay, for the leakages, STI, savings, taxes, and imports. For injections, remember EGE, EGE, egg, E, EGE, exports, government spending, and investments. All right, these are injections, meaning money is coming into the circular flow diagram. Okay, and remember, the purpose of this circular flow diagram is trying to tell us that when you're calculating the GDP using the income approach and the expenditure approach and the value added approach, the GDP must be equal. Okay? When you spend on a good, that is someone's income. Okay? That person sold you a good, which was their output. So the, your expenditure equates to someone's income for producing that output. Okay, that's what the circular flow diagram is trying to illustrate. That theoretically, all the spending equals all the income, which equals also all what is produced. Theoretically, okay, colleagues, these are just theoretical models. Okay, you will never hear in parliament or discussions with economists, you never hear them talk about the circular flow diagram. Have you ever heard of the governor of Bank of Zambia talk about the circular flow diagram, Mr. Boniface? Have you ever, or the Minister of Finance talk about the circular flow diagram? These are just models to help you understand, okay, what is going on. Okay. Okay, yes. So number six, in the circular flow diagram, households supply factors of production in exchange for. Here I should have heard about 11 hands raised up. Yes, Madam Yvonne, what is the answer here? Remember, colleagues, you have 10 minutes with about how many questions? 10 questions. So this information has to. It's which one? Yes, that is correct. Yes. B. Remember factors of production: land, labor, capital, and entrepreneurship. Colleagues, did you know as an entrepreneur, you're a vital part of the economy. Okay. In your entrepreneurship course, did you hear that definition? And an entrepreneur is someone who gathers the factors of production and organizes them, the land, labor, and the capital. Were you given that definition? Okay, you should ask your lecturer, okay? Yes. In the circular flow diagram with government included, which of the following represents a leakage from the income stream? Correct. Yes. So if you saw taxes and imports, okay. Now, please do not swap imports with investments, okay? Because there are two eyes. There's an eye in leakages and there's an eye in injection. So remember, the eye in the leakages is imports. Then the eye in the injections is investment. Please do not swap because I'll be marking your paper and I'll send you a screenshot that you swapped here. Okay, I send you a screenshot you swapped here. Mhm. So better hope your CA is good so that when you swap, at least you lose 1 mark. Um, okay, which of the following correctly describes an injection into the circular flow diagram? Okay. Households pay taxes to the government. Households save money in banks. Firms invest in new machinery. Households buy imported goods. Yes, colleagues. Also, so an injection. When we saw here, savings is already a leakage. Huh? Hmm. It's C. Colleagues. Did we get the acronym down? STI, leakages, savings, taxes, imports. These are the leakages. Injections, EG, exports, government spending, and investments. Okay, colleagues? Keyword investment here. Yeah. All right. Calculation of GDP. Gross domestic product is defined as the. Yes. Okay, that's correct, madam. Using the expenditure approach, GDP is equal to. Okay. Be correct. Colleagues, do we remember what each letter represents? Yes, because it's only how many people answering today? Just you, Madam Diana, Mr. Boneface, Mr. Nelson. Yes, just four people, colleagues. What about the others? Why are we not answering? When you say you're following, I don't trust you. Yeah. Yes. Okay. So, colleagues, just hold on. Just give me 3 minutes. Just hold on. Hmm?
Baby! Hey, baby! They had to bring it in inside, huh?
Okay, sorry, colleagues, about that. Sorry. Where are we on? Yes. C is consumer spending. Or did someone explain this? I can go to the next part. Did someone explain this? C, consumer spending. I is investment spending. G is government. Just remember, think of who spends within an economy. Okay. Consumers, businesses through investments. Okay. Governments, government spending. And then you've got foreigners. So this X is exports, M is imports. Exports minus imports. Okay. Yes. Foreign spending. Are we okay with that, colleagues? It's only Madam Cathy was said, okay, yes, Mr. Boniface. Yeah. And remember, these are the shifters of aggregate demand, okay? Should they bring any questions on aggregate demand, aggregate supply graph? Our 22 hours should be done. No, we should be done by 21:30. Okay, 21:30. Okay, so number 11. Suppose in a given year, consumption 500 billion, investment 200 billion, government spending 300 billion, imports 150 billion, I mean exports 150 billion, imports 100 billion. What is the GDP using the expenditure approach? Okay, yes, 1050 billion. Okay, you just first subtract 150 minus 100, you get 50. Then you just add that 50 with these three. Okay, you're using this formula here. Okay, colleagues, are we clear with that part? Okay, which of the following is counted as an investment in GDP accounting? Purchase of 100 shares of Apple stock, purchase of newly built house, purchase of used factory, government spending on a new highway. Eh, Z, colleagues, it is quiet in here. Z. D. That's government. That's government spending. But in actuality, yes, that's some form of that's an investment by government. But here, when we talk about investment, we're focusing on firms. Okay, sir? Firms. Hey, colleagues, D has been cancelled out. Uh-huh. Yes, it's C. Colleagues, can I say now say good night? You remain with these hard questions, these by yourselves. They're just 20. Okay. You- Okay. GDP deflator used to measure inflation, nominal GDP over real GDP times 100. That is your GDP deflator. Okay. It is used to measure inflation. Okay. So, for example, let's say you have year one, year two, year three. So, year one, okay, the GDP deflator is always 100. Okay. Let's say year two, you get a GDP deflator of 110. Year three, a GDP deflator of 120. Okay. So if you want to measure the inflation rate between year one and year two, you just say 110 minus 100. That gives you 10%. Okay. This 10 here, which you've calculated, is 10%. Okay. These are index numbers, colleagues. Okay. So what it means, the inflation rate rose by 10% from year one to year two. Okay. Year one to year two. If you want to compare the inflation rate between year one to year three, GDP deflator of year three minus GDP deflator over year one. So you're going to say 120 minus 100 GDP deflator of 20%. Inflation rose by 20%. So when you take note and take note carefully, when you're comparing with the base year, you're just subtracting and it will give you the percent changes. Okay, if you want to find the inflation rate now between year two and year three, you're not just going to subtract. No, colleagues. No. You're going to have to use the percent change formula, new minus old divided by old times 100%. Okay. So just hold on. Just hold on. Yeah. So colleagues, yes, uh, we'll meet tomorrow. Okay. Yes. Uh huh.